Taxation is a fundamental concept in economics and plays a crucial role in the functioning of modern societies. As high school students, it is essential to understand the principles of taxation, as this knowledge will help you become informed citizens and make better decisions in your personal and professional lives. This lesson will explore the key concepts related to taxation, including the definition of tax, the purpose of taxation, and the different types of taxes based on proportionality. A tax is a mandatory financial charge or levy imposed by a government on an individual or organization to fund public expenditures and government activities. In other words, taxes are payments made by citizens and businesses to the government, which in turn uses this revenue to provide various goods, services, and infrastructure for the benefit of society as a whole. The primary purpose of taxation is to generate revenue for the government. This revenue is used to finance a wide range of public goods and services, such as national defense, law enforcement, education, healthcare, social welfare programs, and infrastructure development. Without taxation, governments would not have the financial resources necessary to carry out these essential functions and maintain a stable, well-functioning society. In addition to generating revenue, taxation serves several other important purposes. For example, taxes can be used to redistribute wealth and reduce income inequality by placing a greater tax burden on high-income earners and providing benefits and services to lower-income individuals and families. Taxes can also be used to influence behavior and encourage certain activities, such as offering tax credits for renewable energy investments or imposing higher taxes on harmful products like tobacco and alcohol to discourage their consumption. It is important to note that taxation is not a voluntary action. Governments have the legal authority to impose taxes on their citizens and enforce tax laws through various means, such as audits, penalties, and legal action. However, in democratic societies, the power to tax is typically granted to the government by the people through their elected representatives, ensuring that taxation is carried out with the consent and oversight of the public. Taxes can be classified into several categories based on various criteria, such as the type of economic activity being taxed, the level of government imposing the tax, or the way in which the tax burden is distributed among taxpayers. One important classification of taxes is based on proportionality, which refers to how the tax rate changes in relation to the taxable amount. The three main types of taxes based on proportionality are proportional taxes, progressive taxes, and regressive taxes. A proportional tax, also known as a flat tax, is a tax system in which the same tax rate is applied to all taxpayers, regardless of their income level. In other words, under a proportional tax system, everyone pays the same percentage of their income in taxes, irrespective of whether they are low-income earners or high-income earners. For example, consider a hypothetical country that has a 10% flat income tax rate. Under this system, an individual earning $50,000 per year would pay $5,000 in taxes, 10% of $50,000, while an individual earning $500,000 per year would pay $50,000 in taxes, 10% of $500,000. Although the higher income earner pays a larger amount in taxes, both individuals pay the same percentage of their income in taxes. Proponents of proportional taxes argue that they are simple, transparent, and fair because everyone pays the same rate. They also claim that flat taxes can encourage economic growth and investment by reducing the tax burden on businesses and high-income earners, who are more likely to invest and create jobs. However, critics argue that proportional taxes can be regressive in nature, as they place a greater relative burden on low-income earners who may struggle to afford basic necessities after paying taxes. A progressive tax is a tax system in which the tax rate increases as the taxable amount increases, placing a greater tax burden on higher income earners. Under a progressive tax system, Taxpayers are divided into different tax brackets based on their income level, with each bracket subject to a different tax rate. As an individual's income rises and they move into higher tax brackets, they pay a larger percentage of their income in taxes. The income tax system in the United States is an example of a progressive tax. As of 2021, there are 7 federal income tax brackets, ranging from 10% for the lowest income earners to 37% for the highest income earners. For instance, an individual with a taxable income of $50,000 would fall into the 22% tax bracket, while an individual with a taxable income of $500,000 would fall into the 35% tax bracket, paying a higher percentage of their income in taxes. Supporters of progressive taxes argue that they promote fairness and social equity by ensuring that those with a greater ability to pay contribute more to the public good. Progressive taxes can also help reduce income inequality by redistributing wealth from high income earners to lower income individuals and families through government programs and services. However, opponents argue that progressive taxes can discourage work, savings, and investment by reducing the incentives for individuals to earn more money and move into higher tax brackets. A regressive tax is a tax system in which the tax rate decreases as the taxable amount increases, placing a greater tax burden on lower income earners relative to their income. In other words, under a regressive tax system, low-income earners pay a larger percentage of their income in taxes compared to high-income earners. Sales tax is a common example of a regressive tax. Consider a sales tax of 7% on all goods and services. An individual earning $20,000 per year who spends $10,000 on taxable goods and services would pay $700 in sales taxes, which represents 3.5% of their income. In contrast, an individual earning $200,000 per year who spends the same amount on taxable goods and services would also pay $700 in sales taxes, but this represents only 0.35% of their income. In this scenario, the lower income earner pays a larger percentage of their income in sales taxes compared to the higher income earner. Other examples of regressive taxes include excise taxes on specific goods, e.g., gasoline, cigarettes, and alcohol, flat rate user fees for public services, and some property taxes. Critics of regressive taxes argue that they place an unfair burden on low-income earners, who often struggle to meet basic needs and have less disposable income. Regressive taxes can also exacerbate income inequality by taking a larger share of income from those who are already financially disadvantaged. Understanding the principles of taxation is crucial for high school students as they prepare to become informed citizens and active participants in the economy.